Hey guys, Keith here again with Barry and McGuire with Ritchie Mill Law Office. In the last episode there we just touched on an introduction to agreements for sale. My follow-up question, Barry, on agreements for sale is it the same as an assumable? Like assumables were really popular, just not that long ago, even over the last few years. It's kind of really settled down. But what's the difference between agreement for sale and an assumable mortgage?
You know, Keith, the main difference between an agreement for sale, or AFS as we like to call it, abbreviation, the main difference between that and an assumable mortgage is that when you assume a mortgage, title changes into your name.
Okay.
And really you're taking over the place of the seller in his existing mortgage.
Gotcha.
With an AFS, the seller is actually your bank, whether he has a mortgage on his title or whether he doesn't. The seller is your bank. He lends you the amount of money that you don't have in cash.
Right.
You pay him a payment based on whatever his loan is.
Okay.
And if he has an underlying mortgage, he takes the payment you're making him and he makes his own mortgage payment. But the key is, with title remaining in his name and him being the bank, he's dealing with his mortgage on his own. You don't have anything to do with it. You're not taking over his mortgage. So very useful for sellers who have little or no equity in a property, have a big mortgage, they're looking to sell, and there simply isn't enough money to hire an expert realtor like you to help them sell, because there's not enough money to pay commission, and they have payout penalties to pay. There's not enough money in the deal to help them work normally with the realtor. So a sale by way of agreement for sale can eliminate those extra costs and still allow a seller to sell with a mortgage in place, but the buyer is not assuming that mortgage.
Now, the last question about that would be the agreement for sale versus the assumable mortgage. Who must qualify in each of those? Does everyone need to qualify at the bank for an agreement for sale versus an assumable?
Well, with an assumable, you have to qualify at the bank.
Okay.
With an agreement for sale...
Everybody does, you mean?
Well, the new buyer really is the one who has to qualify.
Okay.
But with an agreement for sale, because you're not assuming the mortgage, the buyer doesn't go to the bank and qualify. And actually, it would take 5 or 6 minutes to explain my client's experience with going to the bank and trying to explain what an agreement for sale is to the lender, who ends up saying, let me get this straight. As a seller, you're going to continue to make your regular mortgage payment? Is that right? Yes, I'm going to do that. And the title's staying in your name? Yeah, title's staying in. So bankers end up saying, we don't really understand what you're talking about, so we don't care what you do. As long as the payment's made and the title's still in your name, you can basically do whatever you want.
Go do it. Okay.
So you don't have to qualify, practically speaking, when you do an agreement for sale.
Awesome. That is a lot of information. I know it's not possible to cover all of this stuff in great detail on a quick video, but you know where to reach us. Have an awesome day, everybody.